It is April 6th, 2024. This past week was a really interesting week for stocks. Most days, stocks traded lower. We actually had a really interesting day on Thursday where the stock market opened up higher, but then it retreated. If you look at the NASDAQ, it was up about 1%, and then it ended more than 1% down. A 2% retreat is really showing where the market psychology is. I think this market is scared. It's afraid of any bad news. It's afraid of any sell off. I expect the next couple of weeks are going to be very volatile. You're going to have stocks go up, stocks go down, mostly down. And I think sell offs are going to be more exaggerated. I think people are going to be quick to take gains on stocks and realize those gains before certain stocks go down. The reason for my feeling is stock prices are really high, especially for technology companies, companies like Meta, companies like Nvidia. The stock prices are just really high. It's great if you're a stockholder. It's really fun to see your statement and you see your portal and see that big gain. But those prices are just not sustainable. We have to have a pullback in order to have later on a nice advancement and appreciation period. The news that drove the market this week was the employment report and the fact that the economy in the US added more jobs than expected, considerably more jobs, and it drove down the unemployment rate. That's really good news for the economy as a whole. I'm glad that people have jobs, people are working, making money. That's going to increase consumer spending. If people have a job, they have money in their pocket and they're going to spend it. The other thing we saw was that interest rates went up because it's now expected that the Fed is not going to be in a hurry to start lowering interest rates. If they don't lower interest rates, it's going to make the valuations of stocks less expensive, frankly, especially the growth stocks that depend on a low discount rate. Those stocks are not going to have the large valuations that a low interest rate environment would give them. The other thing that we're seeing is that the stock market rose on the good news of the employment data. Both all three indexes and even the Russell advanced on Friday. That was a surprise to me. It was a surprise to see the market really just take off on the good news that the US economy is doing well. We actually have what they're calling is a Goldilocks moment where it's just right. We're having inflation go down. Unemployment isn't a big problem. It's actually low if you compare it to historical rates. So the economy is good and inflation is coming down. All those things are really incredible. And the Federal Reserve might pull off a really special correction or a special moment in economic history where they were able to bring down very high inflation without driving the economy into a really bad zone where we have high unemployment, we have a lot of businesses struggling, a lot of pain in the economy. So if they can pull that off, that'll be great. I hope they do so. That way, people have jobs, people don't get displaced and really put in a bad spot. As for stocks, it puts us in a place where I continue to feel that just stock prices are too high. It's been a really good 17 months of appreciating stock prices, and we have to let some of the air out of the bubble. We have to let the stock market retreat a bit so that we can have prices come down to their valuations and not have stocks just continually go up well above the intrinsic value of those stocks. The S&P went up on Friday, and so did the Nasdaq, the Dow, and the Russell. All four indexes went up. If you look at for the week, all four were down. The S&P was down for the first week of April, 1.16%. The Nasdaq was down 1.3%. The Dow was down almost 2%, and then the Russell was down 2.6. So small and mid-cap stocks went down far more than the S&P. If we look at the month, we have small gains, but they're still really good gains for the S&P, almost 2% over a month. That's great. If we look at year to date, the S&P is enjoying a great 2020-24. Great. NASDAQ is performing really well in 24. The Dow and the Russell are lagging. Small and mid-cap stocks are not catching the rally as much as the bigger stocks are catching it. For the past year, the S&P is doing great. 26.7% return over the last 12 months. NASDAQ's doing incredible, 34.4. The Dow up 16%, which is very good. And the Russell's up 17. So for the past year, I don't know that anybody would complain about the returns. They've been excellent. Looking at the sectors and where they've been performing, I'm looking at the last month of returns for different sectors. The number one sector is energy, and oil prices have really been climbing. Oil prices are above $85 per barrel. That makes oil companies really profitable. It also increases prices for gasoline and other fuels. So that's going to be a burden on the economy, by the way. Communication services, and that's where Meta, uh, Alphabet, Netflix reside, is up 8%. That's a very good return for 1 month. Materials is really going up almost 5%. And to me, that's a signal that the economy is in good health because materials are driven by factory activity, activity of manufacturers, activity in the economy. So that's good to see. Industrials are also up 3.3% a month. Very good signal that the economy is in good health. Financials are doing well. The S&P over a month is up 1.43%. And then the sectors that are lagging, consumer staples, it's just slightly up. Understandably, if the economy is good, investors are not going to consumer staple stocks for safety. They're neglecting those stocks, and that's understandable. Consumer discretionary is down. Information technology is down. I think that some of the air is being let out of the bubble of the AI hyped stocks like NVIDIA, Supermicro Computer, and other AI hype stocks. I think some of the air is being let out of that balloon. Healthcare is still lagging. That has been a surprise for me over and over again. But we'll see when it starts to rally. And then real estate is lagging for the past month. It's down almost 4%. I think those higher interest rates for longer are really pushing real estate down. And I think it'll just make the valuations of properties lower. Therefore, anybody who is either holding real estate or building real estate is probably being held back. It's going to be a lower valuation of their balance sheet. 2024 year to date, it's been going really well. The only complaint I have is it's been going too well. Stock prices continue to rise, especially for the last 6 months. Just the pace that we're on. It's fun to look at my Meta stock and look at it just continue to go up as an example. But I don't believe in fairy tales. I believe in data. And historical data tells me that we're just in for a good correction going forward. We're going to see stock prices come down. Reason for it is smart investors know this cannot continue. It's not sustainable, especially around the stocks that are really pushed up in price in technology and discretionary. Some discretionary stocks were really pushed up in 2023 and at the beginning of 2024. We'll see how it plays out. That's what I'm expecting. And I'm always a student of the market. I always try to do my best homework, manage my investments to the best that I can, try to make as much money as I can for my family. But the market continues to teach me. The market continues to surprise me and teach me lessons along the way. I mentioned healthcare being a big surprise. That's probably been the most consistent surprise for me. For many years, I have appreciated pharmaceutical companies, healthcare companies, because they're just really good companies. They make good money, they make good profits, they generate really good free cash flow. And for some reason, they're just not desirable in this environment. And that's been a really good place for me to learn why and really investigate it. I really appreciate you watching the video, and I hope you found it interesting.